Is Jesse Durham. I teach people how to live and leave a lasting legacy through the infinite banking concept. I picked up this book back in 2015 by Mr. R. Nelson Nash after I saw a presentation where a guy was showing us how to get out of debt and keep and grow money compounding at the same time. I saw in that presentation how to, and I'm going to address this question here. I'm here for a question and answer session with y'all and to share some best practices. I saw in that presentation also how to buy cars and keep your money at the same time. Blew my mind. Completely new paradigm for me. This idea of becoming your own banker. I didn't know anything about banking. I never thought about it. I just worked hard and tried to save, tried to invest in conventional plans and programs, government qualified plans and programs, live life, do things as a family, etc. And just had a real renaissance moment, had a real unplug from the matrix moment. And I'm here to address questions about where you might be at in vetting the infinite banking concept for yourself, share best practices that I've learned along the way of implementing the concept for 10 years now. Me and my wife have used this concept for everything from paying off our student loans, paying off our family car, and paying off credit card debt that we had from back in 2015. And now we've used this private family banking system that we've built for financing family vacations, paying property taxes, buying business equipment, covering family business. That's actually another live workshop that I need to be giving soon. I've given a poll recently on the channel. You can go to that poll on the channel. It's still up and cast a vote. But debt recapture, family banking, lots of different subjects were on there. Family banking was a popular subject that y'all seem to want to hear more about. So we've done a lot of financing within our even extended family. So not just my household, but our extended family. All right, so today, and I'm going to see if I can share this because I have folks that are messaging me right now as we speak, actually, wanting to make sure to see this. So let me send that in. And by all means, you can put your questions, whether you're seeing this live, I'm live now, but in the replay, you are more than welcome to still put comments or a question in the comment section below. I will come back to that and I will address that. That's actually what I'm showing up with today is some notes of questions that I've had this past week, and I'm going to walk through those. Okay, thanks. I'm getting a thumbs up. Appreciate you, Joe. Beautiful. I'm going to address some questions that I've received just this week from different sources, online, consultation calls, etc. So let's start with something like business expenses. So I had a great consultation call with a prospective client this week, and we were talking about business implications. This gentleman was wanting to know, okay, Jesse, how can me implementing this infinite banking concept affect how I handle taxes each year? And this is an advice. I'm not a tax expert. Okay, seek your counsel elsewhere. But we pay taxes, okay? And I think there's a more efficient way to handle any financing that you do to include taxes. What are the implications with infinite banking for what I'm doing in my business when it comes to taxes? What if I need to procure another vehicle? Okay, and Nelson has a chapter in the book on business equipment finance, very, very integral part of the book. So I'm always going to encourage you to get back into the book itself. Sorry, just checking comments. Yep, I see that. Appreciate you. And then there was a third, well, thinking long range in my business, how can infinite banking play into my strategy to step away and not be so active in my business. This might turn into a business consultation call. But actually, on that note, I've got a series on my channel. So if you go to durhamtalents.com, it will direct you, of course, to my YouTube channel. Of course, this video is on YouTube where you're seeing me now. So I have a particular series called my Life Lessons series. And I'm showing people how to use the ideal asset in their business. So I've got a particular, I believe it's the 6th life lesson. It's infinite banking for business owners. Feel free to check that one out. If you're a business owner and you have a lot of money that goes through your hands, really, when you look at the end of the year, when you're impressed by, oh, we had a great year, we had a lot of money go through, but how much of it did you keep? If you're in that position of experiencing cash flow, but not retaining cash flow, and therefore not being able to compound that and grow that into the future and get your money to work as hard for you as you are working for your money, check out that particular video. I would encourage that. So let's talk about these 3 different steps that I've tried to lay out in the business context. And everybody is in a business. If you are pursuing a career, W-2 income, your household is your business. Everything is financed, Nelson says, okay? Either we're going to somebody else, like a bank, and we're asking that bank to borrow their money so that we can provide them collateral, fill out their paperwork, pay them interest dollars, etc., if they qualify us, right? If they approve us. And that's the one conventional way. The other conventional way, of course, is we save up cash ourselves, okay? And when we have enough for what we want to buy, to finance, we spend it to buy that thing. And then we have that thing. And it's better than the conventional financing of credit. Okay, so there's credit and then there's cash, because we forgo paying someone else interest. But here's what that also means. We don't have the money anymore. And then that means that, and this is just, people like to give grief over stuff like this. This is just toy money. This is just for illustrative purposes, okay? My money is in whole life insurance policies. And I've not said that. If you're new to the channel, here's the ideal asset. Let me tell you right out of the gate. The ideal asset that you can personally own is a whole life insurance policy from a mutual life insurance company that pays dividends. Now, I said something kind of lengthy and very specific right there. If that's new to you, I'm just telling you, the best use of your time, get into this book, Becoming Your Own Banker by R. Nelson Nash, and watch the main video on my YouTube channel. It's called The Presentation. It's the Infinite Banking Presentation. It's right on the main page of the channel. Watch that. I encourage you. Take notes, write your questions. So all that to say, the ideal asset that we can own and use to compound, okay, in a guaranteed fashion, what we earn in a private asset, the whole life insurance policy, and then still also leverage that policy to go out and do whatever it is that we were going to do anyway, like buy business equipment, okay, or pay off debts or go on vacation or any of the things that I've already mentioned. It's the third C. It's the third method of finance. Because if we just did cash like we were talking about right there, that money's gone. It can no longer work for me and my family. So credit, we're paying somebody else interest. Cash, we're losing the opportunity to earn interest that we could have, okay? The third way of finance, the one where you're unplugged from the matrix, the one that's out of the box, the one that's unconventional for you liberty-minded folks out there, okay, is privatized banking, not commercial banking, privatized banking, where you own the asset, you own the banking entity that you're using for your need of finance. All right, so let's go to this business context here, where this individual that I was speaking with, this gentleman, doing great business, okay? But he has all the normal business things to deal with, such as taxes. Okay, so if this individual is making those quarterly tax payments, okay, to Uncle Sam. That's a cash method of financing. Money has to be set aside somewhere because that's for taxes, okay? And when there's enough there, or it's time, then those taxes are paid, and then those monies, that money is gone. It paid the taxes for us, but it's gone. Here's the difference, okay? Let's say instead we added one step to that process. One step. Now listen, you don't have to work harder. You don't have to change your cash flows. You don't have to take any additional risk. You don't have to lose control, okay? This process is simply adding one step to what you were already doing. If you added the step of taking your cash flow and directing it to a new location, such as the whole life insurance policy, okay? And a policy at the end of the day is just a piece of paper. I'm kind of a visual guy. Maybe you've caught on to that already. I'm kind of a visual guy. So let's just say that this is going to be my policy, and boy, oh boy, is this going to be ugly, right? But it's just a piece of paper with the word policy on it. Y'all know what insurance is like. It's just a contract. It's just paper, right? It's something that you've signed and you own, and you pay premiums to be able to own this thing. Okay, policy, all right? I put the money in the policy. You pay premiums to own this policy and have all the benefits that that policy is going to give you. Now, with a whole life insurance policy, that means, let me do another maneuver here. Thanks. And while I'm doing this, y'all please feel free to put your questions in the comments section. I will look at them and answer them live or come back to them. But by adding that one step of putting the money into an appreciating asset that I'm going to own for my, now watch this, whole life. That's another big reason why we're using whole life insurance, because I'm going to own this for my whole life. That is guaranteed not to go down. That value will never go down. It's a legally binding contract. It's guaranteed to grow. It's guaranteed to be leverageable. It's guaranteed at the end of the day, worst case scenario, worst financial occurrence that could happen for my family today is that I graduate, is that I die, is that I pass, okay? I go to see Jesus before my family thought that I would. But here's the other aspect of that coin, the other side of that coin. 100 out of 100 Americans die, so it's going to happen. So, but in the unlikely event that I were to go sooner than expected, there's a guaranteed death benefit also to this. So out of the gate, you have a guaranteed protection, again, while still having all those other guarantees of being able to leverage this appreciating asset. So I changed one thing. I added one step. Remember, I had to pay taxes for the business, okay? I directed the money to go to this private asset that I own, where my money is going to stay in there and grow and compound. And yet, because I own this, I can leverage this, and the insurance company will send me money because I own this. This is my collateral. They will send me their money via policy loans. So I've got a tax-free, watch this, I've got a tax-free access to a compounding pool of capital for my whole life to be able to go out and do what? What do I need to do? I need to go pay the taxes. Hey, Rob, I see you. Appreciate you. Thank you for the comment. I still get to go and pay the taxes. So I pay the taxes, okay? But what do I have now? See, now instead of just paying the taxes, who still owns that appreciating asset where the growth and the compounding on all the premium dollars that I've ever paid is still taking place in this contract that I still own. So by adding that step, it's just a more efficient use of my dollars. I'm literally getting more than one job accomplished from the dollars that I experience in cash flow by growing an asset that I'm going to own and control for my whole life and still able to leverage that asset to go out and pay for taxes for my business. Amazing. Fantastic. Okay, so then let's go to the next question that this individual had, which is, Jesse, how long, okay, I'm reading this, how long would it take me to get to $20,000 for a vehicle? Okay, so in this business, vehicles can be necessary. Obviously, lots of businesses need vehicles. Well, here's the answer. If you were paying credit-wise, okay, again, remember what that looks like. You got to apply, you got to ask for permission, you got to pay interest. What's the collateral in that relationship? Well, the collateral would be the vehicle itself. If for whatever reason you could not pay a payment on that vehicle, the collateral is going to be pulled out from under you, because that's the nature of that relationship of commercialized banking. Okay, home, same thing. Don't make your home mortgage payment. See how long you continue to own your home. It's just that way. The cash method, if I'm going to procure a vehicle, is, well, I've got to save up the money that I need so that I don't pay somebody else interest. But again, remember, if I'm going to pay cash for a vehicle, what happens to this money? It never works for me or the business again. So what am I going to consider doing? I'm going to consider, here's the answer to the question. I'm going to consider, how fast can I put then more money into this appreciating asset to build up enough equity, to build up enough cash value to leverage and have access to $20,000 that I want for my vehicle purchase. So the numerical answer is, what's going to be, it depends, right? It depends on whether you're talking about starting a brand new policy or whether you already have a policy. This individual did not have a policy yet, so let's just start there. If you're starting a brand new policy and you need to buy a $20,000 vehicle, well, we know for sure you're going to put at least, and you will put more, you're going to at least have to put $20,000 into that policy via premiums, okay? And it's going to be more than that. So here's where I can say, and this is so important, I don't have a cookie cutter approach to working with clients. I believe that every individual policy should be properly structured for the individual. And that's why I was having this first of what will be many interactions with this prospective client, so that we can get, of course, all the education, all the answers, all the information squared away to where, well, Nelson even says it in his book. He says, when you know what's going on, you'll know what to do. Nelson himself said that. When you know what's going on, you'll know what to do. So my role here is not to tell you what to do, but it's to help you understand what's going on when it comes to you paying taxes for your business, or you financing a vehicle for your business, or helping you better understand how to be more efficient with an exit strategy from your business, and those types of things that I was having a conversation with this gentleman about. So you're going to need to build up that much capital in equity in a policy. Now, the equity in a policy is called cash value. That's what folks like Walt Disney leveraged to launch his idea of Disneyland. That's what folks like J.C. Penney leveraged during the Great Depression to be able to cover payroll and overhead during that massive financial storm. Okay, that's what folks like Miss Christopher, who launched the Pampered Chef. Okay, that awesome business that, you know, I've bought stuff for my wife, she's bought stuff for herself from that company. That was launched because a lady had a policy that she owned, and she was able to have contractual rights to money for this idea that she wanted to launch in a business, because she had the policy that she owned, which meant that she had access to the insurance company's money to be able to have policy loans to buy whatever it was she was doing to launch that business. So for a vehicle purchase, the answer, the simple answer is, how quickly can I get to $20,000 for my next vehicle purchase? Well, how quickly are you going to put at least $20,000 in here? Because you're starting this, okay? If you were starting a fund in a savings account or under your mattress or in a hole in the yard, okay? Secret, hidden, right? If you're going to start a $20,000 fund for a truck there, for a car there, you're going to put $20,000 there. So that's a good place to be able to start, okay? And anything beyond that, of course, is just going to play into your long-term plans. Let me know if I'm doing good in my explanation so far down in the comments. And then let's address this third issue that this businessman was asking me about, okay? Because we talked about how to be more efficient with the cash flows to take care of those quarterly taxes or those yearly taxes, okay? How to be more efficient with your money. Get your dollars to do not just one job and then be gone, but multiple jobs. And then a vehicle purchase. Great use of a policy. Controlling that purchasing, okay? Because let's pause here real quick before I do move on. I kind of started in on it when I mentioned, remember what it's like if you've got a loan with a bank. If for whatever reason you hit some exigency, some emergency pops up that you did not foresee, the bank doesn't care. If you don't make a payment on that car, they're going to come get the car. That's how that's going to work. It's a business. Banking is a business. Well, when you own a policy that you have leveraged because you're the owner and you can do that by contract, not asking permission, you can just do that. Look at the difference in the nature of collateral. The collateral with a car loan from the bank is the car itself. The bank can take the car if you don't make the payment. If I have an outstanding loan, because I borrowed money from the insurance company, while my policy, remember, still compounding, appreciating, uninterrupted growth, okay? Both those things are taking place at the same time. I'm borrowing money from the insurance company while my money grows and compounds uninterrupted. Amazing, this relationship that's going on. What's the collateral in this relationship? And who holds it? Well, the collateral is the policy itself. This policy already has a death benefit guaranteed that far exceeds the amount of money that the insurance company has loaned me. So what's the collateral? It's the death benefit. So what happens is I get to decide then when I take a policy loan from the insurance company, I get to decide, because I own this policy contract, when I pay that back, how I pay that back, if I pay that back. Now, I'm going to be the first to encourage you to be an honest banker. Banking is a great business. That's why all these banks are on every street corner. They're the nicest buildings in town with the best kept grounds, aren't they? In your town, just like they are in my town in North Carolina, okay? Beautiful businesses, great businesses, very profitable. That's why they have branches all over the place, okay? And they're still popping up, still popping up. I drove by a new bank this week. That's crazy. That's crazy. Anyway, it's not crazy. It just makes sense. It's profitable. The relationship is so very different. The collateral, when you are privately financing from a policy that you own and control, if, let's run the worst case scenario. Let's say I don't pay that policy loan back. What happens? There's no collateral to pull out from under me. What happens? Well, even in the worst case scenario, and that's the year or the day or the week that I die, when I have an outstanding loan balance of that $20,000 for that truck that I bought. Well, remember this, my family, watch this, my family now, instead of the conventional financial method, instead of my family still owing on that vehicle and not having a death benefit, that's scenario one, okay? Scenario two, I guess if I paid cash for it, they'd have the vehicle, no payment to the bank, but no death benefit. Isn't this one the most superior way of financing then? If I financed the vehicle purchase from policy loans from this policy, my family has the vehicle, doesn't owe anybody anything for it, and my family is going to get the death benefit minus the policy loan because I already got that money. Already got it. My family already has that in the truck, in the car. It's already parked out in the yard, right? It's already in the driveway. And they get the big old death benefit that the company was already on the line to pay for. It's the most superior method of finance. It's a way for you to be able to keep what you earn, okay? Because you redirected funds now, cash flow now, to this private asset that you own and control for your whole life, that's eventually going to culminate in an income tax-free windfall to the next generation, or whoever you designate as your beneficiaries. And yet, throughout your whole lifetime, you're going to have a greater and a greater access to capital that you can leverage for your need of finance. Doesn't matter. Here's the other thing. Doesn't matter. When you call the insurance company up and you own one of these policies, they got two questions. Once they verify, are you Jesse Durham from North Carolina, your personal info? Yep, it's me. You want to have access to policy loans? They got two questions for you. How much of what's available to be sent to you do you want? Half of it, a certain dollar amount, all of it, like how much? And then the other is, do you want a check in the mail or a direct deposit to the bank account we have on file? And you tell them, and they send it. And that's it. It's the most superior method of finance. So I hope that was particularly helpful, going through a lot of those business issues. These are just real life business issues. You business owners, you entrepreneurs out there, these are the things that are on your mind. Paying taxes, buying the next equipment, the next tool, the next machine, the next thing that's going to level you up in your business. That's going to separate you from the competition. Everybody has competition, okay? Now, here's what I will say. Y'all have heard the statistics like I have, all right? So 95% of businesses fail in the first year, they say, okay? So just think about this with me for a second. We're really on a business run here. I love it. Hopefully you do too. If you implement this concept, you're going to win against your competition by default. That's the claim that I'm making. Okay, that's what I'm proposing here. The idea that you could become your own banker, that you could implement infinite banking, and you're going to beat the competition out. And here's why: if you're controlling the repayment on the things that you finance, if you're growing and compounding and appreciating your capital for your whole life, I mean, what business do you know of that still has money and still goes out of business? The only reason that would happen is if they just chose to close the doors. I mean, I'm not saying that it's good to run a business with bad leadership or bad management, right? I'm not saying it's good to run a business with inferior products and services. But what I am saying is, he who has the gold makes the rules. Okay, it's called the golden rule. He who has the gold makes the rules. It's hard to go out of business if you still got money. You understand what I'm saying there? Do you follow me there? So if 95% of the businesses that there are go out of business in the first year, okay, could money issues be a part of that? I think so. I think so. All right, I'm just being egregiously facetious now. But I'm having fun with it. And I know that this is beneficial because I've helped folks. And here's a great chance for me to say that, listen, I work with blue-collared folks, hard-working American patriots, okay? I help you keep more of your money. A lot of y'all just happen to be business owners as well and do things. So I don't care. Again, it doesn't matter. Households, businesses, investors, it doesn't matter how you're earning money. There are only two ways to earn money: people at work or money at work. People at work or money at work. Most times, it's just people at work. We're not putting our money to work. We're not told or taught or instructed in school or church or home, okay, or from our employers that just want us to clock in and do a good job, okay. We're not told by them how to become our own banker, how to put money to work, how to make money like the banks make money, okay? We were just told, if you were like me, you're in my generation, you were just told, go to school, make good grades, go get that 4-year degree, work hard, climb the ladder, and you're going to be successful. Well, I found myself in 2015, married, second child was just born, I was in a great, stable career, and I launched my first business that year, 2015, and we were tens of thousands of dollars in debt. doing all the things that we'd been told to do. I was putting money into my 401k while paying on the car and paying on the student loans and paying on the credit cards and paying. See, that blows my mind that we're told in the same breath, we'll put money over here at risk that you can't touch for the next 40 years. But then we're also ending up in debt for all the things in life that we're going to do. Okay, so I know that we're going to do these things. I'm saying there's the credit way, there's the cash way, and then there's that compounding way. All right, so those are some answers for business. I do have some other questions that were asked of me this week that I want to be able to run by y'all. Joe, I appreciate you having jumped in. Rob, I appreciate you having jumped in on the conversation and letting me see you. Let me pull up these other questions here that I've had. So one question was, if I'm paying premiums, then take a policy loan for a recurring expense, how do I pay back the policy loan also? All right, great. So this question is really in line with what we were just talking about when it comes to taxes. So let's just keep going. So how do I, because there are some different cash flows going on here, okay? When you implement this concept, you are paying premiums. Okay, you're experiencing money however you experience money, right? From your job, from your business, you're experiencing income. You are paying premiums. Now, premiums can be paid once a month. Premiums can be paid once a quarter. You can make semi-annual or annual premium payments. Okay, so all of those are options with whole life insurance. You can pay once a month, once a quarter, once a year, twice a year, whatever works for you. You have those options. So that's one cash flow, okay, is our money systematically, regularly going to this appreciating asset. Then here's another cash flow. Anytime that we take a policy loan, and again, I'll use taxes just for an example because we've already mentioned it. When I take a policy loan from the insurance company, because I own one of these policies, okay, they have to put the money to work, the insurance companies. I, as a policy owner, just happen to be first in line. Beautiful. So when I take a policy loan from the insurance company, leveraging my policy, and I go and I pay my taxes, okay, the taxes got paid, I want to refill what I just leveraged. I want to refill it back in the policy. So yes, I'm still making my regular policy premiums every month, every quarter, every whatever. But I paid this quarter's taxes and I want to prepare for next quarter's taxes. Okay, so that policy loan that I took, I also want to systematically build that back into the policy because I did leverage that cash value. It did diminish. If I took out, okay, what did I take out over there? If I took out, let's just call it $20,000. If I took out, I got two tens here, so if I took out $20,000 from the insurance company in a policy loan to pay taxes with, I want to systematically start putting that same $20,000 back into the policy, back to the insurance company. And now here's a really good place to talk about interest. Okay, so the cash flows so far when you own a policy are regular scheduled policy premiums, once a month, once a quarter, however you have that set up. Okay, and let me touch on this point about the amount. That's not a direct question that I have here today, but people are curious. Well, Jesse, how much does it make sense for me to put as premium into the policy? What's appropriate for me? Again, my belief is that when you know what's going on, you'll know what to do. That's why I have private consultation calls with my clients and prospective clients. If you would like to have a conversation with me for free, where we can walk through what it would look like for you to implement infinite banking, if you would have a clear picture of what that process would look like, and for you to have your specific questions answered about how you can implement the concept, then get in my calendar at durhamtalents.com. durhamtalents.com. Otherwise, to address the how much question, I've got a video that I feel is really helpful from what clients tell me, and it's titled How Much Premium. I'll put it below in the show notes. I'll make sure to put that below in the show notes. Make myself a note. I got to make notes so that I'll remember to do things. I'll put that video in the show notes below. I actually just shared that video with the gentleman that I was discussing earlier that I had a great conversation with from Michigan. Great conversation. So you've got these cash flows going, all right? You figure out the answer to your own question, how much premium, okay? Then you're making these policy loan repayments when you want, how you want, okay, at whatever rate makes sense for you. But I want to get the same money. Remember, you're just adding one step. So you are already setting aside money quarterly if you're making quarterly tax payments. So just keep doing that. But you've changed the location. See, now you're not just putting that money in a savings account where it's just sitting there, not doing anything for you, and then being spent on taxes and being gone forever, out of your hands, out of your business forever. No, that's refilling the reservoir of this leverageable private asset that you own. It's refilling the reservoir. And oh, by the way, because you're still making your regular premium payments, that growth and that compounding keeps etching up. Every day that I'm alive for the rest of my life, watch this. Every day that I'm alive for the rest of my life, owning policies like this, and I own 7 policies. All right, I started back in 2015, just learning about this concept. Worked to get my first policy going. Used it for that debt recapture. Paid off the student loans. Paid off the family car. Paid off the credit cards. And then now I've acquired several more over the past several years. Every day that I wake up alive for the rest of my life, I will have more cash value than I had yesterday. Tomorrow, I'm going to have more cash value than I have today, and it's not here yet. I'm telling you, it's the ideal financial asset to own for all the reasons that I've mentioned and many that I have not. I'm aware of more than a dozen reasons, characteristics that a whole life insurance policy has that makes it the ideal asset to own, let alone making it the ideal asset for our use of capital for financing, okay, for financing. So if you've got a recurring expense, that's what the cash flow looks like. You're paying premiums to own, to grow, and to compound your earnings, your income, as you experience it in the policy. And then also, when you've leveraged insurance company money via policy loans to go out and finance the things that you're going to do anyway, like pay taxes, well then as you continue to experience income, okay, or returns on your investment, or whatever it is that you use that money for, you're going to start systematically putting that back into the policy as well. Being an honest banker, okay, it's going to go in the policy. Let's get it in here, okay? It's going to go in the policy. You're going to be an honest banker because remember, banking is a process. A policy is a product, okay? Policy is a product. Banking is a process. This is the ideal product to own. It's the ideal asset to own. Whole life insurance, properly structured from mutual companies that pay dividends. We haven't talked about dividends yet, y'all. Dividends, okay? These mutual life insurance companies have paid dividends for well over 100 years. Now, just think about the history that's taken place over the past 100 years. We're talking about during the Vietnam War, okay? We're talking about during World War II. We're talking about the dot-com bubble. We're talking about the housing crisis, 2008. We're talking about, the world ending, 2012. We're talking about the Spanish influenza at the start of the 20th century. So these companies have not only met all their obligations, but they've been profitable and they've shared those profits with policy owners. So dividends are actually not part of the guaranteed growth in a policy. So you have guaranteed growth and then you also have dividends. But they've paid these dividends for over 100 consecutive years without missing a single year. Incredible. It's the ideal financial asset to own, to be able to use and leverage for your need of finance. so many advantageous characteristics to it. I feel like I was on a point that I didn't wrap up very well there, but I hope that that's answering the question about, well, Jesse, what if I'm using, and that's one of my more popular videos on the channel. It's an older video, actually. I have a general episode on recurring expenses. I'm sure that I should put that in the show notes for you as well. I'll make a note. It's one of my more popular videos, is using infinite banking for recurring expenses. I can put that in the show notes below so that could be helpful to you. But as you would have paid back anything else or staged more money for the next tax bill anyway, do that. But you've just changed the location. That's what we were talking about, product and process. This is the ideal product, the whole life policy, and then there is the process of banking. I'm here today to encourage you to consider the idea, to vet it, to learn about it for yourself. Watch my introductory presentation video at durhamtalents.com. Get a hold and read. This is a quick read, y'all. Large print, big pictures. Go to the source information for yourself. Vet the concept for yourself. Book a private consultation call with me. Be about the business of banking for yourself. You will have the control that you've, for all your life, have had in the bank's hands, okay? Where you are literally, if you're conventionally financing anything, okay, for your business, for your household, doesn't matter, you're literally promising the bank and giving them now future earnings that you have not experienced. If you got a 5-year note, here's what I'm saying. If you got a 5-year note on a car, you're promising them earnings that you've not even experienced yet over the next 5 years. If you have a mortgage, you're promising the bank earnings over the next 30 years that you've not even experienced yet. If that's not the literal definition and exhibition of financial slavery, then I don't know what it is. But I think I do, and I think that's it. I hope that this has been helpful to you. I hope that you have seen a way for you to be able to live and leave a lasting legacy. Live a lasting legacy. Like this gentleman, he's building a business, doing great things. We didn't talk much about that exit strategy. There's a lot there, okay? As you continue to own and use a policy that, again, is compounding in a guaranteed nature for the rest of your life, just ask yourself this: how big do I want those numbers to be? If I know that I'm going to experience a growth trend, constant and upward and uninterrupted, when would I want that to start? How many of those would I want to have? Okay, because if you knew that every dollar of income that you experience that you could put into this appreciating asset would be there, guaranteed, no loss of principal. I always think of Warren Buffett's quote of, remember rule number 1, don't lose money. Remember rule number 2, refer back to rule number 1, don't lose money. So don't lose money, right? But then once you understand that that money can grow and compound and experience a constant upward growth trend over your whole life, how many of those would you like to have? How big would you like those numbers to be? How soon would you like that to start? I had a great interview on the channel, so it won't be released. I just had the interview today, but I do have an interview series on my channel. Feel free to check that out. Spoke with a gentleman whose parents started a policy on him when he was 4 years old. Used that policy to buy a house after he and his wife got married. Incredible. Now family with their 5th child on the way. Incredible. It's going to be Dan. Okay, so just know that that's coming out. Dan, I appreciated that conversation that we had today. What a beautiful story. Really neat, really interesting. But when it does come to exit strategy, say from a business, if that's where you are warehousing your wealth, if that's where you are building up capital, is in a system, it should be a system, okay, over your lifetime, you should be building a system of these policies. Banks open up multiple branches. I own multiple policies. That's the idea here. You're going to have access to everything that you've paid, plus all the growth, okay, so you can leverage it, that system, and have passive, does it get more passive? Passive supplemental income in later life. And again, remember at the end of the day that there's also a death benefit always tied to this contract. Talk about an exit strategy, okay, from a business. When you're looking to go more hands-off or even completely hands-off, maybe you want to sell the business. I mean, here's where we can get real strategic, and I will with this gentleman, where you can talk about, well, you need to be creating a place for the windfall of that business. Because here's what I know. People that hate paying taxes as much as this guy does and as much as I do, when there's the sale of that business and we experience a big windfall of capital, would we like to place that capital, that windfall, in a tax-free environment or not? Of course we do. Of course, if we could get that capital in a tax-free environment, we want to do that as soon as possible, okay? Well, the policy, okay? When you put money in a policy via premiums and you're taking those policy loans, and it doesn't even have to be policy loans. That's what I would suggest for a few reasons, more than I can go into right now. You could take withdrawals from a policy, and that could be part of your supplemental passive income plan, actually, in fact. And that's part of the reason why it's so important to work with somebody who's knowledgeable and knows this concept, because they've implemented this concept for themselves. Not just own life insurance, okay? Not just write you a life insurance policy, but properly structured from a mutual company that pays dividends for the purpose of infinite banking. But anyway, you could have withdrawals. There are no taxes on that. You could have policy loans. There are no taxes on that. And at the end of the day, you've still got the death benefit that's going to be an income tax-free windfall to the next generation. So it's a beautiful exit strategy. It's the ideal exit strategy. It is the way to live and leave a lasting legacy. Okay, I am tapping out here. All the resources I've put at your disposal. It's been my pleasure to address these questions with you. I would encourage you to check all, if you found interest in something particular that I've mentioned. I'll put more links in the show notes below. In the meantime, you can connect with me and we could talk by going to durhamtalents.com. And it is my hope that you live and leave a lasting legacy. Have a great day. Take care.